Good afternoon. My name is Scott Redler, Chief Strategic Officer at T3Live.com, and I'm here with actually the luxury of having Keith McCullough, the CEO and President of Hedgeye.
Thanks for having me, Scott.
No, thanks for coming on the set here.
Yeah.
You know, a lot of you guys, in our community know who you are. A lot of people follow you all across Wall Street. You know, they see that you're making progress, you're making advances, you're pretty much everywhere. You look, you're up how many hours a day, you think?
Too many.
Too many. What time do you get up in the morning?
4:03.
So
that's
wow.
about as much as I can squeeze out of this thing. So yeah, get up early.
And I'm up, I think, at 4:45.
Yeah, you're the only other guy that's awake, so we're like Twitter buddies at that hour.
Yes, I'm like, I just sleep last night.
Exactly.
Well, anyway, you know, I'm happy to have Keith here because I wanted to ask him a little bit about his business, where he's going, his direction, because I know that you just put together Hedgeye TV, which is a platform where people could hear what you have to say when you want to say it, and you don't have to, go to any network for that. You could just do it, in your own house, so to speak.
Yeah, I think it's an important, like you've done here, it's important to show the ecosystem that you actually operate in. I think that the difference with current TV, you can go on pretty much any channel and you have to operate under their rules, under their kind of like sound bites, and
they give you a minute.
Yeah, you give you a minute, and they ask you, by the way, they ask you what you're going to talk about, so you kind of get your own questions front run, and so it just doesn't work. I think that what works is showing people what you actually do. And I think that that's not only the value of what I think we do on the analytical side, but what you do on the trading side, is show people what you do, and they'll either be comfortable from a transparency perspective with that or not. And I'm very comfortable showing what we do, because I think that there's a lot that we can teach people.
And what is your core business right now?
Well, right now it's like institutional research. So about 90% of our revenues are institutions. So pension funds, mutual funds, hedge funds, they basically pay for our long-short research. And what we're getting into now is also the individual or the registered investment advisor businesses, where it's a different price point, but we're still giving them that same real-time access. So if we short Kinder Morgan, for example, which is a call we've been making lately, right. I mean, our institutional client gets that call at the same time that the smaller guy gets that call, because the smaller guy needs it too.
Right.
The institutional guy might get a lot more depth in many cases, like a 65-page slide deck on why we don't like Kinder Morgan. But the point is that it's all right there, real time. There's no huddles or anything like that.
Well, that's great. Everyone gets it at the same time, so you're not like picking and choosing, who gets it first based on the size of their wallet.
Yeah, exactly.
And that's kind of what we do with T3 Live. Also, we have a subscription-based model where everyone, as basically has a subscription to the virtual trade floor, has a subscription to Off the Charts, and some people manage billions, some people, a few million, some people 100,000, and you get to see the same ideas that we're looking to institute on a daily basis, in order to trade as well. So by not having I think just some brokers out there that might go after the guy that gives them the biggest order,
yeah.
Right, the biggest commission.
You mean that happens?
Never. No, never has happened before. So you don't want to be the last phone call, and it's already 3 days later.
Yeah, and look, I mean, that was my life. I had my own hedge fund. I worked at some of the major hedge funds, and the reality is that that's your life. You're always worrying about who's front running you. Okay, where did this information come from, and who has it on before me? So, that's really the vision of Hedgeye. It's to show people right here and now, this is the idea. And guess what? I can be early. My analyst can be early. A PM who's sitting there by himself in his bathrobe couldn't be right on timing, and the guy who runs, $200 billion can be right on timing. There's no say here in terms of who actually gets that information and interprets it and really puts it on in the right way. I mean, I think that that's really the point.
And I think, just to not even dummy it down, but to dummy it down a little bit, because you do deal with all these big guys, you also talk about a lot of the tickers and the names that are moving in the market. I know, on Twitter, when you have your, that last hour, you're giving me tweets, the 10 stocks that you're typically going over, you're going over pretty much what my traders are looking at, because they're the most active, they're the most in play, they're the most, they trade by technicals, they do have volume, there's a story behind them. So, when I watch you actually do that, I'm like, wait, we're trading Tesla, we're trading Apple, we're trading Bank of America, and you seem to come up with the technical and the story. Do you have a research team that has you do that? So when you get the tickers, everyone's looking at them and figuring out what exactly goes on there, because you rattle them off quick.
Well, it's the top 10, and I do crowdsource that because I think idea generation can come from anywhere. Look, this is like a meritocracy. I mean, people don't have to. The call doesn't have to come down from Goldman upon high that this is now a new idea. So what I do is I say, give me the top 10 in terms of the heat, and to your point, there's either some volatility or there's some volume. The things are moving. So if I have analysts on it, that's where I really am one of our sweet spots. But we don't always have an analyst on the stock. We have 27 analysts currently, which is as big as I think most, at least buy-side firms. So we do have like a lot of girth on the research side. So what I marry is really my own risk management process from a trading perspective as a hedge fund PM and my research team, and all they do really is research throughout the day.
All right, well, that's cool. And it's on all different time frames.
Yeah, so we try to be duration agnostic as well, which is, I think, typical of a very good trader or PM. I mean, I don't care if it's a short-term call, an intermediate-term call, or a long-term call. What's really good is when all three of those durations really fit the same glove, and those are the big calls. The ones that you can ride.
That's probably when you take a core position in a stock ready to go after a 6-month base that could last for a long time.
Yeah.
Which is what this bull market basically has been, with some intermediate corrections along the way.
Right. I mean, the whole style factor of growth is what's really worked. So growth stocks, they've been bullish on an immediate-term trade basis, we say, an intermediate-term trend basis, and a long-term basis, and that's as powerful as gold has been bearish on all three of those durations. So you get a lot of people this year that have been trying to whine about this top. There's like how many people have been trying to call the top in U.S. stocks? Meanwhile, there's a tremendous amount of big macro charts that look like hell. But you're not calling the tops in these things. So gold, bonds, I mean, some epic short calls that have been trending to the downside. So what I think is important is being able to go both ways on macro in that regard.
And identify the trend and stick with it until it changes. Because they do change sometimes, and you have to be flexible. And I know, for most of this year, I feel like, you've had a trending up market. You've had rates inching higher, and the market's been getting comfortable with that. Actually, I think in the last month, good news was actually good news. And I think people like that. And I know, again, I follow you on Twitter, and you seem to get pretty, heated about what the Fed didn't do. And, what do you think as far as like just going over some charts for the fourth quarter, the ramifications of that?
What they didn't do was do what everybody thought they were going to do. And if you're going to be the head of the Federal Reserve and you're going to tell everyone you have communication tools, he knew damn well exactly what Wall Street was expecting, and he took it upon himself to change his mind. And I just don't think that that's really his job. He's an unelected central planner, and I think most people know that I rant about that. But the point is that he blew up the two big things that I really liked in the market, which is a rising trend in the U.S. dollar and rising 10-year bond yields. So those are pro-growth signals. I like to see that. So when you hammer both of those things down like he did, I don't like that. So this has been like one of the first dips that I'm really reluctant to buy because two big macro components no longer look good because of Bernanke, because of what he didn't do.
Because you basically give a leg sweep to everyone that was thinking a certain way. And if you go to the chart right here, let's just go to the SPX. I think a lot, first of all, we talk about the trends and we talk about the move that happened since November. And it's been a strong move, got tested in June and then got tested here in August. This is when I think everyone came out and said we're going to have our 15% correction. But you know what? It didn't happen. Okay, we crossed above it, took back the 50-day and continued. And then right here was the Fed day. So, anyone that was short, okay, here rolling it up or rolling it up from here probably got squeezed out, okay, because how could you stay short going through this price point? And then anyone who wasn't taking on risk probably put it on, and then all of a sudden, boom, you just got a little blasted here. So, just like me, nobody really wants to buy, like I'm just, do you sink your teeth in right here when you can pull back to the 50-day or pull back to the trend line? So I think there's like there's apathy on Wall Street right now where people feel like they got blasted, because even with gold, right? If you were short gold, after that move, it's like, oh God, I got it covered a little bit here, and then Goldman flipped and said, no, maybe we were wrong on our short, calling gold, and then 2 days later, it gave it all back. So the shorts got a little thrown off and beat up. The longs might have added, and then they wound up losing, and now everyone feels like you can just spin around and and lose money, which no one likes to do.
No, you feel like you spent time in like the washing machine, and you come out and you're like feeling all nasty about it, and it's bad. So I think that there's like some real event risk as you go into the fourth quarter. I mean, this employment report is point number one. If this thing is a moonshot to the upside, the whole thing reverses again, because October taper comes back on, bond yields could be up. I think bond yields could be up 20 to 25 beeps in a day. So you kind of take that chart and superimpose that, and you're going to have so much confusion at that point, because so many people that have been wrong on the bull side of the stock market climb this year have fundamentally believed that if interest rates are going up, that the stock market's going down. That couldn't be more wrong. If rates are rising, the stock market's rising. Last 5 days of the correction, rates were falling, stocks were falling, dollar was falling. So now today, this morning, rates are up on a good jobless claims number. Dollars up, stocks are up. Can they hold? And I think you got to wait to that next big boom period, because the Fed at some point has to acknowledge economic gravity, at least in terms of how they communicated it. And I think that employment report is like a really important event.
So and we'll see how things react.
Yeah.
If you go like I've been with you on rates rising, starting in the 2013 thesis, we try and put out 8 or 9 ideas, 6, 7 stock ideas, some macro. I even do a little macro, a little macro.
Everybody,
I'm like, Japan looks good,
Yeah.
which you've been on top of also, and I'm like, rates should be rising. Economy's getting better, housing market's doing better. So we've been talking about the TBTs for the majority of this year, and once we got into the Fed time. Okay, I said, you know what, guys? It's been a heck of a move. All right, you've had a lot of tradable areas along the way. If we do break this and there's some kind of either priced-in event or if they change or switch gears and you're not committed, get out. Because from here, you probably could get a move to either the 50-day, which we're coming into right now, okay, or maybe a little bit lower. And right here in the TBTs, what would you say is the spot that you would feel compelling to maybe buy this versus where the the yield is?
Well, on TBT itself, I'd have to load it in my machine, but I mean, it would probably be 3% lower or thereabouts if I just kind of back into what that would look like, because for me, it's all about the 10-year bond yield. So 2.55% is my trend line. Like come hell or high water, we can go to hell or in high water. I don't care. I mean, really, that's the way I think about it. I'll let the market tell me what to do. If we're below 2.55%, there's no way I'm going to go back to the TBT or TLT or any bond position on the short side for that matter.
And where are we right now?
And we're right around 2.65. So you're in a spot where everyone's confused for good reason. You're approaching, like I call it, the waterfall. I mean, if you're about to go over the waterfall and rates are about to break down back towards 2, everything that you've done for 9 months, you do the opposite. Okay, so you wouldn't, like, if you're me, you got to wait and watch here, because the market's going to tell you on a big employment data point what precisely to do. And I think that's why in an environment like this, you take down your gross and your net position. Because what else are you going to do? You're going to guess? I mean, I'm not going to guess.
That's exactly what I've been saying for 2 days, because traders are like, do we buy 5 days down? And I'm like, but you know what? We're not even at the 50-day yet.
Right.
So you buy 5-day down, which has been working. It may not work this time, so no one wants to get rolled over. So like you said, low gross, low net. What we talk about in like our terms is we call it, cash flow trading. Level versus level, make a little bit of money. Don't put too much risk on until we get more clarity. And right now, there's not that much clarity out there because we don't still know, like you said, the jobs report. Is it going to be good news, and will the market take it as good news?
No, exactly.
Will it be October or is it December? So everything we've been trained for all year that's been trending and keeping us on the right side of the market is now a little bit in flux.
Well, particularly, jobs reports, by the way. You can give me the number. It's not my style, by the way, to take on orange jumpsuit risk. But if you gave me the number, I still wouldn't know what to do with it. I'm gonna be reaction dependent basically in this regard, because we actually have no idea what the big move is going to be, but I know how I'm going to react to it. So again, I pick a line. I'm committed to the line. That's my model, and I think that's the best kind of risk managed approach to that.
Well, it's kind of like what traders do with their stops.
Exactly.
When the trade changes, you change along with it.
Yep.
We talk about with a lot of our traders that if you're in a stock and you're in a position, you stay in it as long as it is in the trend and has a right reason, and while that reason is intact, you stay there. But if the chart changes and it breaks a level and it's no longer a momentum trade for you, you get out. If it's a swing trade, it's different. If it's an investment, it's different.
Yeah, it's important.
I remember one time you called me out. You're like, why aren't you getting back in yet, or something like that. I'm like, well, when you break the 8 and 21-day moving average, which has been my process, when I'm in portfolio approach, then I get a little bit, a little risk off.
Yeah.
And he said that to me in the first quarter. And obviously went another 100 handles higher, but it's just part of the process. Is okay, we broke that, risk off. If we actually go to the chart of the spiders, I'll show you where that was. Let's actually go to
this. This is in the first quarter, probably, wasn't it?
Yeah, this was right. This was right around here. This is when everyone wrote their doomsday thesis. Remember that?
Well, this is when Doug Cass and I fell in love.
Right, and we won't go into that. but anyway, here's that 8-day. Here's that 8-day moving average. Okay, trending. Broke below it, so I got a little bit into cash. Right, nice move from here, from December to this, broke it, and then right around here, I think you were buying into that. I'm like, you know what, I'm gonna wait and see, because I want to see it resume that trend, and it did. Okay, it wound up resuming the trend, reclaimed the 8 and 21-day moving average, and then went from from 1530 all the way up to the highs here. And then it's funny because you look at these breakout failures. This was a breakout failure. Broke above, squeezed some shorts, got some longs in, came back down. So you could have been out of the way and been fine with it, sleeping well at night. And then, once it went, held higher, you could have even waited for here into that another move, into a breakout failure. So, all in all, part of my process, 8 and 21-day, I try and stay in portfolio approach. We start breaking below that. I get a little bit more tactical because, wait and see.
That's the point. If you have a discipline, you have a risk management process, the hardest thing to do is to stick with it.
Right.
And the reason why we look different on Twitter is because we're dependent on levels. we go with the market first. The market tells us what to do. The market's going to tell me when to pull back. The market's going to tell me when to get aggressive. You know, the current Wall Street structure is, you know, God thank them. I mean, they're all smarter than us because at least that's how they articulate it. They are certain. You know, they are certain that this is going to happen.
When you say certain, oh my goodness.
And to me, that's not like being a strategist that doesn't start with what Mr. Market's telling you. To me, is like I think that that's pretty dicey. So again, embrace uncertainty.
Right.
Take your process for what it's worth. You use different levels than I use, but at the end of the day, I think we have one very simple thing in common. It's discipline. Right. And that's what you got to do. Because if your lines hold, you can wait. Again, you know why you waited, and you're not going to miss the next 100 handles to the upside. And that's the point.
And just goes to show you, like, watch your discipline. Look, we talk Tesla all the time, right? Every naysayer out there has been against it, but what did it do the entire time?
Oh, love this stock.
Followed the 8 and 21-day moving average. One day it broke below. This was that Goldman call when it said 80 bucks, and then you had that red dog reversal right there. Resumed it, held higher, and continued to go. And that's what we do. We follow trends in growth names. You know what? They grow into their valuations, they grow into their P's, and if they don't, the trend changes. Look, another one, 3D printing, just I shorted this morning. This was, you know, a strong stock. Everyone was like trying to short it. I said, wait till you see something change. What changed right there?
Exactly.
The trend broke, and then it never got reclaimed, and look where it is now.
You know, this is a great example. Like, I fundamentally believe that Wall Street reverse engineers the story after the price action occurs. So again, this is going to be epic type storytelling. When Tesla, if it ever breaks, you're going to have the bear case painted out in spades. But on the way up, the harder case to paint is why it could keep going higher. And that's the point. Higher highs perpetuate higher highs, and higher lows in the absence of a catalyst. I mean, you can't short valuation. To me, if it's going to trade at 500 times earnings, it might as well trade at 1,000 times earnings. That's not a short case. Timing is.
Right.
So again, like those kinds of stocks, I think they're actually really tough to get right for the precise reason that people can't comprehend why they're working.
Right.
And they're working because people chase price.
Well, that's why they say also guys like me kind of dumb money. We're technicals. We don't think too much. As long as it stays above the 8 and 21 day, we stay with it. If there's a tight pattern, breaks above, holds above, you buy more, and you go that way. And then the guys that think they're smart, that think it's overvalued, they sometimes can't stay solvent all the way.
Oh, exactly. I mean,
unless their pen runs out of ink instead of their P&L.
No, being
like sometimes it's the pen, it's not the P&L. So they can stay with it longer until they're eventually right. But traders will probably get blown up, and you know they can't stay as long as until 6 months when it finally ticks or whatever.
It's so true. I mean, look. I mean, the biggest mistakes I've ever made is because I think that my research is smarter than what the market's saying. Every time, I can go back 15, 16 years, every major mistake is because I said I'm smarter than you to Mr. Market. And the reality is I'm not. I mean, you could check this. I think I have the lowest SAT score in my entire college class. So, dumber can be better because you don't really overthink things, and you stay true to your process, true to the discipline, and you bang that out. You do that over time, you're going to make a lot less mistakes, and that's really the name of the game.
And you keep working on it, and that's how you make a living.
Yeah.
All right, well,
thanks
for having me. This is Keith from Hedgeye. Tune into his Hedgeye TV. You see him everywhere. I don't got to give him any kind of introduction. And hopefully we'll just keep making moves in the market, making people money, and keeping people out of the way, and on their path to whatever their process is.
Exactly. Thanks, Scott.
Thanks for having me.
Yeah.